You don't wake up poorer. No alarm, no notification. You wake up with the same salary, the same bank balance, the same number on your screen, and yet something has already been taken from you quietly. Imagine putting an ice cube on the table. You don't see it shrink, you don't hear it disappear, but when you come back later, it's gone. That's how money loses value, and right now, it's happening faster than most people realize. Here's why this matters today. Not in theory, not in textbooks, in your grocery bill, your rent, your savings account that feels safe. Let's rewind a bit. For most of history, money was simple. You earned it, you saved it, it waited for you. Then something changed. Modern money doesn't just sit still, it moves, it leaks, and sometimes it's designed to. When people hear inflation, they imagine prices going up. But that's the symptom, not the cause. The real story starts earlier. Governments and central banks constantly add new money into the system. Not suitcases of cash, just numbers, digits created with a keystroke. That new money doesn't land evenly. It doesn't arrive in everyone's pocket at the same time. It enters quietly, through banks, through loans, through financial markets. By the time it reaches regular people, prices have already adjusted, so your money didn't lose value overnight. The measuring stick changed while you weren't looking. Here's the uncomfortable math. If prices rise 6% a year, your money loses 6% of its buying power. Even if the number in your account stays the same, that means money you worked hard for last year now buys less food, less fuel, less time, and savings accounts rarely keep up. That's the irony. Doing nothing with your money feels safe, but in this system, doing nothing is a decision, a slow one, a quiet one, but still a loss. There's another layer people miss. Inflation doesn't hit everything equally. Assets like stocks, real estate, and businesses often rise faster. Everyday wages usually lag behind, so people who already own assets feel protected, sometimes even richer. People who rely only on income feel squeezed. Same economy, very different experiences. This is why headlines can say the economy is strong, while people feel broke. Now add one more twist. Debt. When money loses value, debt becomes easier to repay. You borrowed in expensive money, you repay in cheaper money. So inflation quietly rewards borrowers and punishes savers. That's not an accident, it's a feature of the system, and it creates a strange pressure. Spend now, invest now, don't wait, because waiting costs you. The hype tells you money is neutral, just a tool, just numbers. The reality is more unsettling. Money is a moving target, and the rules can change without your permission. Zoom out far enough and this shapes entire societies. People chase assets not because they're greedy, but because standing still feels dangerous. Trust erodes. Short-term thinking wins, long-term planning becomes harder, all because money melts. Slowly. So here's the real question. If your money is designed to lose value over time, what does saving even mean anymore? And more importantly, who benefits from you not noticing?